Hello, and welcome to the Pinnacle Economic Brief. This is for the third quarter of 2025 and part of Pinnacle's Effective Advice series. I'm Rob Garcia. I'm the regional chairman for Pinnacle in Atlanta. And with me today is joining me Mac Johnston, who is Pinnacle's senior economist and market analyst. Welcome, Mac.
Thank you, Rob.
First of all, thank you for a great report. By the way, anyone can obtain a print copy of that report. It's located on pnfp.com/econ. So, Mac, let's talk about the second quarter.
All right.
To say it was an action-packed second quarter is probably an understatement, but I think you're used to it now after about 18 months of rough and tumble economic world.
That's right.
Tell us a little bit about some of the changes, particularly the most notable one is the One Big Beautiful Bill. Everything you read and hear from D.C. is there's a little bit of something in there for everybody, and other people say not so much.
That's right.
What can our clients expect from the One?
Yeah, I think the Big Beautiful Bill did a number of things. I think we'll start with, if it hadn't been passed, you would have had a large tax increase or a rollback of the tax cuts that happened in the first administration for President Trump. Second thing, by passing the bill, it makes permanent those tax cuts that were in his first bill. It removes taxation on tipping with a phase out. It has some provisions for lower taxes for Social Security. And on the biggest thing it's doing for our clients is increasing capital spending and allowing expensing of factories and equipment that you purchase versus forcing you to amortize it on your balance sheet. So that has our clients can expense that equipment or those plants and immediately start earning assets versus depreciating against it, which will provide a boost to investment in the U.S.
Some of the opponents of the bill have spoken, obviously, about Medicare cuts and all of that. Walk us through what some of that means.
Well, I think that generally the OMB put out a report that said there was about a $3 trillion over 10-year cost to this bill. I think the OMB, their numbers are somewhat flawed because they assume static growth. I think you should get higher growth with a lot of provisions of the bill. You have to fund these bills. I mean, you've had increased government spending, but I mean, overall, I think that the U.S. will perform better with the lower taxes and with stimulative items on plant and equipment than they would without them. Okay. And had you had the tax increase, the probability of recession would have moved much higher.
Okay, great. Well, I think the second big policy change is obviously tariffs. I mean, that to say that changes daily is also an understatement. I think just Friday we got some new tariff policies that were rolled out. I think the couple European community countries are seeing some pretty sharp increases. Mexico, Canada. Tell me and tell our clients what do those tariffs really mean to businesses, and really how do they impact consumer spending?
Well, I think at a baseline, when you look at tariffs increase the cost for items, which means you lower demand. And from an economic level, you're increasing the price level and lowering GDP growth.
Right.
And so when you look at tariffs, I think what President Trump announced Friday was an attempt to speed up negotiations with a number of allies, specifically Mexico, Canada, and the EU. I think that you hope that those will never come into effect. I think the Trump administration announces a lot of things that never become permanent, but it's all a negotiating ploy to get where you're going. But I would say that overall, inflation has risen since the third and fourth quarter of last year, and that's why you sort of see the Fed not cutting rates. But overall, tariffs are inflationary and lower demand, and if you've got to this point at the consumer level, to our businesses, they decrease margins. But at the consumer level, generally the distributors and retailers have paid for the tariffs. Mm-hmm. And the money you've brought in is substantial. It's running about $20 billion a month.
Well, and that's that was an interesting statistic that he had or the administration has talked about was the tariff revenue is pretty substantial. Right. So I guess that goes toward the coffers of the Treasury.
That's right. And once the government, they get hooked on the revenue, and once they go down this road, they continue on the revenue, just like the Biden administration kept the first-term Trump tariffs in place, I don't know what will be permanent, but whatever is permanent will stay there for a long period of time. We've got tariffs going all the way back to the 1920s that are still on the books of the U.S.
Well, and we have the one big beautiful bill. We have tariff policy that is just a big part of discussion and generating some revenues. How does this affect the one thing that everybody wants to hear? How does this affect interest rates? And where do you see the Fed? How do you see the Fed responding to this?
Well, I think the Fed's mandate is to have full employment and stable prices would mean low inflation. And so tariffs are at odds with that strategy because they raise prices and lower growth. So it puts the Fed in a difficult place. I think the tension between the chairman of the Fed and the president has contributed to the Fed becoming more hawkish and not cutting rates. They cut rates 100 basis points in late 2024. We believe they need to cut 50 basis points this year, maybe 50 or 75 next year, and get to some terminal rate to stimulate growth. But by waiting and not cutting, they've presented economic risk that what we're seeing is lower GDP growth today, much lower than what we saw. And for 2026 and 27, you're talking about 1.5, 1.7 growth versus you were above 2% in the last couple months of the Biden administration.
You talk a lot about growth. You mentioned growth a number of times there. I know personally you follow growth because I hear you present to our leadership team every Monday the GDP growth. Talk to us and talk to our clients and explain why growth is important to businesses and consumers.
Well, I mean, GDP growth to our businesses in the simplest form would provide top-line revenue growth. And without GDP growth, when you talk about deficits and spending bills and taxation and tax cuts, you need growth as a way out. And growth heals a lot of wounds. Growth from a fiscal standpoint with the U.S. will mean in real terms deficits will decline because you look at deficits as a percentage of GDP. To our businesses, growth will provide higher revenue opportunities and higher earnings and more earnings leverage within those businesses. So it's the necessary sort of elixir for the Western capitalism to work.
Right. So assuming you look at a snapshot of the economy today and say nothing else is going to change dramatically, where do you see GDP growth happening this, where do you see it going this year?
Well, unfortunately, if you read the newsletter, I believe that we were past the worst of the tariff period, and I was optimistic for second half growth and the tax and spending bill, a big, beautiful bill, providing a backdrop for that and for the administration to focus on deregulation and energy independence and medical transparency, which would be beneficial to business. Unfortunately, we're still now in mid-July, and tariffs are still at the forefront, which at the margins are destructive to growth.
Let's talk a little bit about the markets. You mentioned the markets. You cover that a good bit in your report. Clearly, there were some sectors that were real winners in the second quarter, and some sectors that probably struggled and are really having a hard time getting going. Talk a little bit about the winners and losers in the markets.
Right. Well, I think when you look at the U.S. economy, just from an overall standpoint, growth has been slowing, as I mentioned. The jobs market has been weakening. So when you look at the sectors that have done poorly, say in the second quarter or year-to-date basis, those would be sectors very consumer-focused, consumer discretionary. These would be stocks like Best Buy, TJX. Then you've got consumer staples because you've had higher price levels of all goods during the Biden administration and somewhat far in the second term of the Trump administration. Inflation has meant that households are buying smaller baskets of goods. So consumer staples has been impacted, so has healthcare. And then on the flip side, the really positive areas are areas that are somewhat exposed to technology investing, artificial intelligence. Those would include information technology, communications, and industrials, because you've got to build all the power plants and all the equipment and to build these server farms to make artificial intelligence work.
So some of those winners and losers will probably stay kind of in the same place for the next, some little while anyway, because I think for the most part, it's going to take a while for some of those sectors that haven't done well to really pick back up.
Well, I think there's a couple of things going on there. I think the valuation disparity between the winners and the losers is very high, so you could get reversals. But overall, until the Trump administration really focuses on re-stimulating growth and not focusing on tariffs, which are destructive to growth, you're going to have sort of a negative bias within the economy and sort of a lack of decision. People aren't going to make major decisions because there's a lack of business confidence.
That's right. Well, thank you, Max, so much. We appreciate what you not only do for Pinnacle, but certainly this information is so helpful to our clients. And I want to remind everyone, you can find this information on our website. It's pnfp.com/econ. And in addition to this economic information, there's a whole host of learning tools that we provide as a value add for our client base, and that's also at pnfp.com/learning. So, Mac, thank you so much. Look forward to hearing what next quarter is going to be like, and appreciate all you do for Pinnacle.
Thank you very much.
Thank you very much, and goodbye.